Gosh, under-recognized investment opportunity.
If everybody's kind of doing the same thing, everybody's going to get kind of the same type of returns. At least for some percentage of capital, it'd be really great to see, people really think strategically in terms of where things are going and where there might be opportunities to make that even better.
So I think we should not be too anxious to invest again in sectors who might not be appealing right now. Retail is a great example.
Supermarket anchored shopping centers we think are very well positioned today. They're seeing solid rent growth, occupancy growth.
Retail is kind of back, I would say. Certainly the grocery anchored, pharmacy anchored retail centers have done well, and we expect they will continue to do well.
If you wanted to take 10% of your money and put it on a high-risk strategy that may provide outsized returns, I would give a try to the office sector. It seems to be coming back, and if you're in a location that has a lot of amenities, barriers to entry, and has proven to be an asset that tenants want to be in, that could prove to be a real winner.
And besides that, also we look at multifamily because everybody needs to live somewhere.
Most of the market is relatively afraid of investing in the Oakland multifamily market. I would be all in.
I've actually invested personally in the distressed office and multifamily space.
There is no new development taking place in those markets. They've reset from a pricing or asset valuation standpoint. Occupancies are pretty stable and rents are starting to grow.
It's a bit overpriced right now, so I'm not sure I'm putting a ton of my money in that, but we would continue to put our money in development in Boston for the next year and a half.
I would invest in alternatives, those life cycle driven events that will make people want to go to student housing, to senior living.
Unequivocally, senior housing properties have the best growth prospects. You have 80 plus year olds being the fastest growing demographic in the US. And a certain portion of them are going to need to live in an assisted living facility. We have almost no new construction of assisted living properties. So we think the senior space is the most attractive space in the public markets today.
People are getting older, so also medical offices are more important. Life sciences.
Digital billboards. We invested in One Times Square, where the ball drops in New York City. All those LED signs, we actually bought a substantial stake in that company, grew that business, sold it for over $500 million to a large private equity firm about a year ago. Very good investment for everyone.
It would probably be in something that doesn't require a lot of money in exchange. So maybe outdoor storage is interesting, manufactured housing.
Our money is being placed where our mouth is, so we like the strategy very much of the manufacturing space.
I think with the affordability miss that we have really worldwide, but especially in the US, I think there's going to be forms of manufactured housing that probably elevate the quality without elevating cost. And maybe that's going to be an interesting place to be.
Express car washes. It's more mom and pop, but if you can aggregate it and scale it up, you'd be surprised at the economics.
How do you beat express car washes?
Well, that's data centers. Everybody is talking about data centers. It's very hot. The sweet spot at the moment for many, not for us.
Any sort of infrastructure related to AI and data centers is going to be a good place to make a bet, but you think you need a very large pile in order to do so.
But those centers use a lot of energy. So in a world where we try to get our emissions down, it's also a little bit strange that now we're focusing on data centers, which are energy absorbing.
I think that's an area that is going to surprise everyone in terms of its performance across and its ability to transform all our lives across the next several years.
I wouldn't want to say one thing here on something which is an evergreen video because it could change. We found too often people will go out and buy stock that we recommend. We're long gone and they're like, hey, it went down. I'm like, yeah, but it went up a lot before that. So that's how we approach it.